Good evening, everybody. This is Jeff Scott. It is Sunday and 4:31 Eastern Time, Sunday, August 11th, and I believe that would mean that future markets are not open, which is pretty certain of that, but just to show that I'm not front-running and using the information yet. Last traded Friday, August 9th. I hope those of you that have not been here before, well, first of all, welcome everybody. Those who have not been here before, hopefully had a chance to review the video where I review what I do, how I do it, and what the indicators mean. Those who have been here lots of times will be happy to know we're going to skip all that stuff today. That's why I did it as two parts. And I will continue to refer folks back to part one that I did last night, which was the tools of top-down investing. So today will be the second part of a three-series. This part will be my market review, and then the third part will be on Tuesday with a live in the market presentation taking Q&A. And George Roberts from highgrowstockinvestor.com, HGSI, will be there with me to answer questions about the platform and the program. Let's make sure I got everything set here. Nothing like doing a whole webinar and realize you forgot to turn on to sound. So my slideshow presentation will be very short, and then let's take a look at the market. It is 4:33. I will be done at 5:30. Part of this is to prove how much one can actually do in an hour with this program. That's my current email address, jeffrey@highgrowthstockdoc.com. It is different than HGSI because of the DOC. Remember, three-part series because I'm bored in retirement. This is part number 2. Part number 3 will be Tuesday. Disclaimer, educational purposes only. Any recommendation of the Ministry of Education on investment advice. I'm a doctor, not a broker. Remember, most physicians, and I used to lose money with their investments until I sort of started to figure this out. And I am independent, including independent of HGSI, and I paid for all my tools. Don't miss the upcoming seminar on Sunny TV. I actually remembered to pay for it last night. And we have discounted hotel rooms at the Courtyard Marriott, which is 10 minutes away. It is the best bargain you'll get in investment education. The little guy here in the picture, not so little, but in the picture, Ian Woodward is a true student and teacher extraordinaire of the market, and not sure how many more of these he's going to give us. So highly recommend it. I would say that we have a market in transition, and we'll look at all these or many of these issues tonight. There is clearly divergence, and I'll show you divergence with the MACD. You could also look and see divergence in the number of new highs, and I'll show you that as well. There are weakening internals. I'll show you as the number of stocks in accumulation A are getting lower and lower. The number of stocks beyond their 10, 20, and 50-day moving averages are getting lower. As Chris just put out, Chris and I have been talking about EdgeRater this week with Hindenburg's. There are clearly two, and I'll show you how close we were to a third, and we'll talk about the significance of that. When I look through my charts today, both top-down and bottoms-up, clearly a rotation to more defensive stocks, gold, silver, metals, miners. Seasonals are against us. August and September are not the best times in the market. And we've also are climbing a wall of fear. There is some concern in some quarters about entropy at the Fed and Treasury with changing in leadership. Reducing easing is inevitable, and every time a Fed talking head brings it up, the market pulls back. China, I can't tell if it's growing or not. I know my VIPS is off the wall and the number of Chinese stocks showed up. I get the impression that China at least is telling us they're getting a little bit stronger. The U.S., I guess it's getting stronger too. Sometimes it doesn't feel that way, and I don't think the numbers have been that outstanding, but I guess they're good enough to start tightening. And is the EU growing? I think there's a lot of chatter that says that the European Union and potentially other emerging or more emerging markets are getting stronger. So perhaps we just have a rotation in place and we continue to press harder. I think the risk of a correction here, and that correction doesn't have to be giant, is fairly substantial. So enough PowerPoint, and again, I refer anybody to the one that I did yesterday, which were the tools of top-down investing, and my hope will be that I can eliminate some of the excess discussion before I go into the data going forward, and intermittently I'll work with George to put up a basic PowerPoint like I did last night. So the next thing I wanted to share with you then would be, let's start to take a look at the markets. Some of the stuff I think is pretty interesting, but then again, now that I'm retired, watching TV is sometimes interesting. Here, everybody knows I like to go into TradeStation to look at the elder indicators, and I look at a couple of different things. I look at the price action, and I look at the color of the bars. Elder paints them red for sell or hold, blue, it's okay to buy, sell or hold, and green, which is buy or hold. You can't sell on a green and you shouldn't buy on a red. And you can see that the daily and the weekly now have gone to blues. Certainly the weekly pulled back somewhat near highs of all time. We've come back off the upper envelope here. Last week I pointed out that I was concerned about divergence occurring. I'm not great, by the way, at drawing on this, so MACD divergence I saw was pretty bad here, and I still think so. I think that making a new high here and barely making a nubbin on the MACD is somewhat worrisome. I guess I could even say perhaps that we had a similar divergence, although not nearly as impressive looking, just a little bit. We did not make a new high on force, even though we made a new high in the market. And then we can see we're at the high jump bar here. We're at 88%, so we've come off the top. I'm concerned about this divergence. If I look at the Dow, remember I was concerned last week. The Dow is clearly leading us lower. Last week I talked about the divergence at this new high. Now you can see we've had 4 negative days on the Dow, and the Dow has turned red on the elder bars, which is a very bearish sign. The Dow is blue on the weekly, and it looks like, I think it's turned blue on the monthly. And you can see the MACD histogram has flipped over. So the Dow, not near the lower channel, sort of in the middle, but the switch to red is clearly a bearish change. And the S&P 500 reverting between blue and red, clearly in a bearish posture here, blue on the weekly, green on the monthly, and again the MACD histogram is flipped. Now you could even argue that the rise in the market to new highs barely went positive on the MACD, and that to me is a very bearish signal. So I look at this and I see a market that's tired and doesn't have the energy pushing it up as it did over the last several highs. So divergence is back, divergence is bad. I like to look at the group performance analysis and to get an idea of, if the charts look bad, but is the market really looking bad, or am I perhaps jumping the gun? So let's take a look at some market performance. So I looked at, let's go to the end of week, GPA ending 811. So this is a easy test in HGSI where I basically identified a number of groups I like to watch. And then I imagined that I bought shares at the end of the day on Friday the 2nd, sold them at the end of the day on the 9th to get an idea of 1 week performance. And this helps me understand what's working, what's not working. And I know that when growth stocks are not working, my portfolio suffers. So first thing I noticed is that the S&P 500 is way down here at a -1%. The NASDAQ may be a little bit better. We'll look at those numbers later. The Dow, I think, down 1.5%. I also noticed that the number of groups that I watch that are negative outweighed the groups that were positive. So that's a bearish twist in tone that we haven't seen yet. Now, I did not have in my portfolio price line, and I think the big driver that made the IBD 50 be kind of break even, the HGS 100 even up 1/3% was price line, which was the big driver. Last week I pointed out Unipixel and UNXL as a bottom fish, and I also went on the website, I think on the day before earnings Thursday, and said take off half because it's already had a big run. Didn't do much into earnings, but was up for the week 13%. So I look at the momentum plays, the squeak bongos, the Robert Squeeze, leaders with rising estimates, the GIF All-Stars, that tool, even though more than 50% were negative, there were some big winners there. Pocket pivots did well for the week. But some of our old standbys, including the things that worked the best the prior week, the best of Woodward and Brown, had a tough week. Bottom line is that was an ugly week with more red than black, and the market indices down. Now, it didn't feel, frankly, as painful to me as I thought it would with the down week. And I had a couple of things that did well. As I mentioned, I've got a big position in VITS. That Unipixel I bought some was up 13%. I have a nice position in cores as well. I like to look at bucketology. Now I'm going to blow this up a little bit and then drive it a little bit. So what we have in the upper left-hand corner is what ugly looks like. Now, in bucketology, I'm looking at the number of stocks in the S&P 1500 trading above and below the midline. And green is above, red is below. And you can see on June 20th, the majority of stocks were trading below the midline. And 30% of the stocks were trading below the lower band. Since 95% of stock price action will be captured between the upper and lower band, when you start to see nearly 1/3 of the S&P 1500 trading above or below, one should expect the market to start to move back. So this was about as ugly as I could find. Now, you'll see where we are today, which is sort of in that indecision part. So this is actually bullish looking forward to me, because I know as we start to get pushed more and more to the left and more stocks trading below the lower Bollinger Band, that the market is likely well, the stocks are likely to do what they're supposed to, which is move back within the bands, and that will lead perhaps to price going up. Now, June 11th, so about 3 weeks later in the market, one sees what good looks like, or perhaps not good, because it's kind of bearish actually, because 30% of the stocks are now above the lower Bollinger Band, 94% green. So that's kind of what a top looks like, which would have been about 3 weeks ago, 4 weeks ago. That's what a bottom looks like. This is what I have no idea what the market's going to do looks like, although I think you can tell I'm pretty bearish, and I think the Dow, if I ran the study in the Dow, which wouldn't be very useful, there's only 30 stocks, might validate that. And you could see, shoot out at the OK Corral, 50-50. So the average stock is sitting right on its midline, which means it can go either way. And for those of us that like football, these are kind of like goalposts here, where nothing's at the ends, very little at the ends, very little in the midline, and everything is sort of clumping midway between the upper and the lower band, upper and middle band, and midway between the middle and the lower band. I think that's pretty interesting. I'm not sure that it's overly meaningful, except to say that looks like indecision to me. It doesn't look like a market that's way overbought or way oversold. And I think perhaps what I said earlier on, that we might be seeing some major rotation in place, might show me why it looks like this. That doesn't take away my bearish feeling in the market. I talked yesterday about the Hindenburg, and basically what I want you to see here are a couple things. We had Hindi on May 31st and on June 4th. Now, these are the 5 characteristics of the Hindenburg, or the 4 characteristics that must be true to get a Hindenburg. New highs, new lows greater than 2.2%. Rising moving average, McClellan less than 0, and the new highs less than or equal to 2x the NLs. You could see that we ended up not having another Hindi until a month later on June 19th, or 2 weeks later rather, and I sort of blew off that Hindenburg. We had 2 last week, and I just want to point something out. If you've watched Chris's video, you'll see the same thing. We were extremely close on the 5th, and in fact, there were some folks out there that said or reported that there was a Hindenburg on the 5th. And I think Chris makes the argument, in fact, he's changed the equation a little bit, and I've got a new spreadsheet. And you could see on the 5th, the only thing that we were short on, it's got to be less than 2 times, the new highs less than 2 times the new lows. So we had 7 new highs, or said another way, if we had 2 or 3 new lows that we additional, we would have flipped it again. 3 Hindenburgs in 1 week probably is enough to tell me that we're either at a top or very close to a top. And if we are at a top, as we saw in 07, in July, and again in October, November, we'll probably see more Hindenburgs this week. Do you have to act on it? Well, you got to do what your stomach says. But I think at the minimum, we need to be aware that we have a market that's tired and one that probably is wanting to do a correction. Now, I mentioned that the internals had weakened. So I'm looking here at the S&P 1500 that's found in the broad market indexes. It's calculated, I believe. And I can use this to look at a number of things in the market internals. And I hope you'll see why I sense that the market is going through some internal weakness. This is view number 1, and these are under reference library, under Woodward and Brown archives, index charts, eye charts. You can see that in red and green, the directional movement is coming closer together, and get the cross occurred back here in the beginning of July when we had a run-up. And when the green crosses under the red, it would suggest that we are at risk of a pullback. And the big pullback that we had last year in November into middle of December, or October and November-ish, you can see that the green preceded it by crossing into the red. You could also see that the short-term Bongo Daily and the short-term force index have gone red, suggesting a pullback. On the new highs and new lows, still very bullish looking as they both continue to go up. And this, and some people could use this as a buy signal. I'm looking at it to see if there's any weakness on the new highs and new lows. We like to look at accumulation and distribution. And in times of market strength, one would like to see the A's leading the B's, and the A's and B's being many more than the D's and E's and very few E's. But what we can see here is the A's in the darkest green have really come off their top. The B's have increased some. The C's in yellow are kind of in the middle of the run. And then the D's and the E's are coming off the mat. What you can see here, and again, when the A's cross below the E's, as happened back here, is a bad sign. You can see that the A's and E's are coming together. and at risk of a cross. We can look at the common, again, that A and the E coming together. In a strong market, the A and the E are very far apart. We could also see that the percentage of stocks that are A and B on accumulation has dropped below their 10-day moving average. Again, a sign of weakness. You can see here, you can see here where it went sideways. When it crosses, back here it crossed as well. It's potentially a sign of weakness in the market. Again, the A's and the E's coming close together, and you can see here the C's a little bit more than midline. You can see here looking, again, well, this is the same AE. The blue is the advanced decline line, which still looks like it's going up. The brown is the up-down volume ratio, and you can see it's heading down, which would be bearish. This is a screen that looks for very bearish or bullish days, looking for 5-to-1 advanced decline issues. Green is good, red is bad, and you can see we fired a green a few weeks ago, nothing right now. This is another thing showing weakness in a strong market, and you can see after this eureka in the market, each of them, the percentage of stocks above their respective 20, 30, 50, and 200-day moving averages crossed above their moving average line. And you could see as an element of internal weakness of the market, the 20 and the 30, not yet the 50 and 200 have crossed below their respective moving averages. You can see on the Bollinger Bands here that there's a lot of tightening. Now, tightening could lead to a breakout above or below. My bet is with the other things that we're going to look at tonight, it will be below. McClellan is weakening and crossed below its moving averages. You can see the oscillator below, the summation index just crossing below. So I think I've shown enough here that I hope you would agree with me supports weakening of the market internals. Now, let me open up the S&P 500, and we'll use that as our index right now to look at market performance and maybe to get a less bearish perspective on the market. All right, so this is my favorite view, but that's kind of cluttered. So let's go back to what I was just looking at. Let me go into this view. Let me edit it. Let me give it more time. That should be all. Okay. Let me go up and find a different S&P 500 to use. Yeah, the calculated one was a short. All right, so there we go. So let's just take a look at what we've been through. If we go back, let's just go back to June 12th, June of 2012. From a base low in June of 2012 to the high in the market up here, 72 period, 16% move in the market. Market sort of went sideways, but ultimately sold off to this green candle low in the middle of November. So the end of that was November 16th, and we had an 8.7% decline in 43 days. When I listen to people, including very smart people, talk about how they haven't been making any money in this market, I'm perplexed, because if I just bought and hold good stuff, at the close on Friday, I was up 26% in 182 days. That is a rip-roaring bull market on the S&P. Problem has been, it's not been straight up. And what we've had are a series. Here's one that it was 3.3%. Here's one that was 3%, give or take. Here's one that was probably a little bit more, 3.8%. And here's the largest one we've had in this run, which is, let me redo that one. Which was, all right, try that again and not click somewhere else, Jeffrey. That was a 7%, give or take, decline on the S&P 500. So we've had a huge up move. We've had a number of pullbacks. Now, if I was to start plotting this out, from where we're at right now, 7% pullback would be to a little bit, would be to 1591. The 200-day moving average, which is rising, is at 1536. That would be about a 10% pullback from where we are. Even the S&P, even the 50-day moving average would be at 3.5%. So as I look at it, I think that the most likely pullback is just to the 50. A worse pullback will be the 200. And an intermediate will be about a 7.5% correction, which would be like the one we just had. And if you think about it, look at what do these guys have in common. It pretty much pulled back to the 50, to the 50, to the 50, to the 50, and 50, broke the 50, but got back above it very quickly. The 50 is probably pretty good support, and that would not be, obviously, a very ferocious pullback. If I look at the Dow, we should see some weakness here compared to the others. And we can see it's already come off. This was a tough week for the Dow. Well, tougher for the Dow than the others, and it's already got a red on Elder. And it's low. It's already been down 2% in this correction. But even the Dow, from the low to close on Friday, was up 28.3%. So without spending a whole lot of time looking at the market charts, I think we've done enough of that today. I'm sure people are rubbing their forehead saying it's about time he stops doing that. The market has been quite strong, a series of small pullbacks, showing some substantial weakness at a time when I might expect a big pullback. And I'm shooting, hopefully it stops at the 50, but I'm going to be concerned about all the way back to the 200. Now, they say buy and hold is dead, and I would argue that it's only dead except for when the market's running. I went back to that middle of November, and I looked at if I had bought at the open certain groups that I had measured back at that time, i.e. you can see the data on the best of Woodward and Brown. And I just bought those stocks and forgot about them and held. How would I have done? Well, you would have done pretty darn good. 60% on the top Robert Bongo stocks. Robert Minkowski put something on the board, gosh, a long time ago, Robert. Top EPS with volumes, 46%. Ian's point score, 40%. This is a non-managed group. I did a GIF top 15, and they were up 40%. You look at 152 stocks that had daily and weekly bongos, up 38%. HGS 100 up 32%, IBD 85 up 32%. Best of Woodward and Brown up about 30%, all of them exceeding the S&P 500. And you can see over that period of time, small caps 35%, the Dow up 22.5%, NYSE up 20, oil up 15, dollar flat, and gold and silver taking the big negative hits. Well, I think the time to buy and hold or buy and forget on these is probably over. And the reason why they've done so well goes back to the last few minutes of analysis, which was because the market has been in a beautiful uptrend for quite some time. So we've now looked at the Hindenburg Omens. I've looked at, I hope I've showed you where I was concerned about the market having some internal weaknesses. Now let's go into the program and look at some sector rotation and see if we can't find anything that might look interesting if we wanted to be long. So open up the warehouse view. Put a top-down analysis on Major Markets Plus. I don't have to tell you that gold and silver had a great week last week. In fact, let me take a digression. And I was at a very nice meeting in New Jersey on Thursday and one in Hartford on Tuesday, some investment clubs. And the one in New Jersey, the guy, one of the leaders actually developed his own seasonality software. And we were talking a lot about seasonality, and somebody pointed out that no surprise that gold and silver had such a nice move because they're going into seasonal strong periods of time. And I thought I would just open this up and take a look at that. Here's the gold index. And if you look out in 30-day windows, green is good and red is bad. We are about to go into a seasonal period over the last 10 years where gold is extremely strong. So it wouldn't at all surprise me. Over the next 30 days, for example, I guess GLD we only got data with for 4 years, average up 6.5%, up every year. Take a look at something like American Barracks. And you can see the same pattern. And if I look at the data on American Barracks, I can see that in 10 years it was up 9 years, down 1 year. The year it was down 0.1%. Average monthly, average up period for this August 12th to August 23rd period of time is 5.1. If I extend it from August 12th to September 6th, I get basically about a 10% move. So it's really no surprise that gold, and I believe the same thing will be true about silver. I don't think we have enough time on AGQ, but I thought I'd take a look. Yeah, you can see the same basic pattern in, there's not a lot of years here, unfortunately. But silver, like gold, is going through a seasonally strong time. I guess Wheaton, is Wheaton SLV, or is it SLW? SLW. So here's silver Wheaton, for example. And you see that same seasonal strength in silver that we've seen in gold. And you can see this is strength that lasts for quite some time. So I think that's kind of interesting. and it sort of fits what I saw in the market. Now, why is that true? Well, selling may go away. We know some of the biggest corrections occur in September and October. We're getting into that time of year. If you want to be defensive, you might be buying gold. So back in that warehouse, silver up at the top. Dow had the weakness, S&P 100, so big stocks. S&P 500 did worse than smaller stocks. The NASDAQ composite being a big mix. Volatility, we've already looked at some of the indices, so let's just look at gold, silver, volatility, and the dollar. So let's start with silver. Now, if you remember these from previous weeks, these guys have a pretty profound downtrend. And within that downtrend, this is oil. Within that downtrend, I've been talking that they've got to get above that 50-day moving average. Let's switch it to my favorite view. Obviously, it's a lot more cluttered. But in my favorite view here, I see that my fast-acting weekly actually did turn green. So I'm pretty much green on the bongos except for the slowing weekly. I had a DI crossover. I'm nowhere close to the top of the high jump bar. I had a pocket pivot and a kahuna and got above the 50-day moving average. I want to be long silver going into this time of seasonal strength as perhaps one of my hedges in a more defensive market, one that's rotating into defensive plays. We'll probably look at some silver stocks before too long. Gold. Similar pattern of being below the 200-day moving average, hasn't quite broken above it, didn't have that pocket pivot. Pretty much everything is green. Accumulation is improving. A kahuna on Thursday on Spider Gold. The VIX, it's still low, but it's not as low as it was last week. Now, even with the low VIX, a rising VIX is associated with a bad market. And sometimes these are the most exciting times of the market because when it starts to pull back, it's a great time for the market. So we've got a low VIX, which might make me a little bit concerned as it starts to rise, another evidence of potential market risk. You notice the VIX had a kahuna on Friday as well. Now the dollar weak, I think I said last week, perhaps getting to a point last week closer to the 200, that it might be getting ready to bounce, and dollar weakness has been good for the market and good for commodities. A rebound in the dollar might hurt some of those commodities, and the dollar remains extremely weak. So commodities picked up, dollar weak, a little bit increase in volatility. If we look at where the industry strength is, we see we have 146 groups. And if we go down to two-day force, which is how I like to look at the groups, you can see that 140-something drops to 54. Now, what stood out to me when I looked at this earlier was gold and silver. Gold, silver, and steel. Coal. Coal's been so weak, hard to believe it's number 8. A lot of REITs made it to our list this week. So perhaps people think that interest rates are not going to continue to rise, and it's time to move back into some of these good-performing, high interest rates. A lot of oil and gas. You got equipment and services. You've got some drillers as well. On the weak side, airlines, other diversified financial services. I think those are multinational banks. Let's see. Oops, that's not what I wanted. Right-click on it. The big banks, rather. I'm sorry. The Bank of America and Citigroup showing weakness. Regional banks, utilities, building products, thrifts. So finances were very weak this week. Railroads have something in common with utilities, and they both need to take debt, and so perhaps fear the rising cost of debt. So let's look at where the money is going into from a positive perspective. The way I like to do this is put the force index, rank them by raw combo, and go through the top 10 and see if we find anything that we want to buy. Right-click on gold. So, you know, the first two are probably the big guys in the gold world, and they're both way down. And I think I didn't think I started nibbling on some more American Barracks. I have some in a longer-term account, and I think that, perhaps it's a time to get back into gold. It had a DI crossover. My kahunas in force went positive, still distributing. A big kahuna on Thursday with that pocket pivot, broke above the 200, looks just like that silver index. And I went long some American Barracks because of the seasonality and because of the price action. I don't like buying things below the 200. Sometimes I have to go against my wishes. Newmont, similar, that had the pocket pivot and the kahuna, the DI crossover, not quite above the 50, so it's not quite as acting as well as American Barracks. Here's Gold Core, looks a little bit like American Barracks. You can see how it got above and actually failed here at the 50, but got back above it with that kahuna. So perhaps something to like in the big gold companies. Look at CDE, which has a mixture of gold and silver, and you could see a couple of pocket pivots in a row. A kahuna on Thursday, a DI crossover, everything green. Certainly looks to me like this guy may have bottomed, and that might be another one to consider getting into. Just out of curiosity, let's just take a look at the seasonality on CDE. So still has a couple of weeks of potential weakness, but it does pick up with the rest of the group. Now I might want to take a look at this a little different and notice how it's in its channel. If I'm a channel trader, I like to pick it off at the bottom of the channel, especially in a seasonally strong period of time. Probably a couple weeks early on CDE by seasonality, but from a chart perspective, I think it looks very interesting. Again, bottom fishing, not a growth stock, more of a defensive play. It's fallen by over 50%, and it is a trashed stock, but one that looks like it wants to perk itself back up. Steel, talking about trashed companies that want to pick themselves up. I own some Cliff. It's got both coal and iron ore, so it's sort of both a steel and a coal play. And it's another one of these bouncing off the bottom. Now you can see it's been bouncing for about a month here. It had a huge volume day on Friday, pocket pivots earlier in the week, a kahuna. Everything is green. The problem with Clips, probably not the one I'd be jumping and buying tomorrow, is I think it may fight a lot to get through this 200-day moving average. And I'm going to watch that closely. It is at the high jump, and it's probably, my guess, going to stall out here. See what else do they have that might be a little bit better setup. Rio Valley, the Brazilian iron ore company, similar pattern, a little bit of room until that 200. That's where I expect there to be resistant. A couple kahunas, big volume, a pocket pivot. That's enough for me to get excited. DI crossover, so a number of bullish things happening here. Again, beaten down industries, perhaps a little bit more defensive. ArcelorMittal, again, similar pattern, a couple of kahunas, DI crossover, everything turning green. The challenge for each of these stocks is going to be whether or not they can get above and stay above that 200-day. U.S. Steel kind of looks just like the last one, a couple of kahunas. So it might be fun to nibble in here, but be very careful and expect there to be potential resistance at this 200-day moving average. Third group on the list, diversified metals and minings. So the first five are all a little bit different. So my worst stock move of all time, make sure my wife isn't here so she can't hear it, was Walter Energy. I was convinced when it was about $120, $130 that Walter Energy was going to be taken out, as there was a lot of talk about a leveraged buyout or an VHP or Rio buying it. And you can see that in the middle of 11, the stock got up to about 140. This week killed me. when it fell back to the 200-day or 50-weekly line, I went very long this stock, and that included some risky options by selling some naked puts that were about $30 out of the money. And that stock fell, as you could see, this long red candle, and just punished me on those puts. Bygones, I live to fight another day, and I'm still here. So I have a lot of negative feeling about Walter Energy. That said, it looks kind of like Cliff did to me a week earlier, in that I had two kahunas, volume coming to chart, DI crossover, still distributing, but my other indicators turning green. Had a green candle low a couple of days ago, not near the high jump. It can run all the way from 12 to 25. I think that looks very compelling. And it's called diversified metal mining. To me, it's a coal play. Freeport, McMoran. Again, these are all stocks in downtrends, off the mat with a couple pocket head pivots in kahuna last week, a gold and copper play. This is a play on China improvement, concern about that 200-day moving average as resistance. I'm probably thinking about playing either Rio Tinto or BHP. Big miners hurt. Rio Tinto here, probably my choice. Had a Bible gap up on Friday, kahunas on Thursday and Friday, huge volume on Friday, broke above the 200-day moving average. So if this trades up from here, or better yet, trades down to and holds at that 200, that might be a compelling place to buy. It's hard for me to believe it'll be close to its high jump bar, and I think there's some errors in calculations perhaps when it's above these, but that should be a zero, because I'm not sure. I'm surprised it's as high as it is when it's trading right on the 200-day moving average. So we'll watch Rio Tinto. I think that one looks interesting and made my list. BHP Billiton looks just like Rio Tinto, but a few days before that, it has to get above its 200-day moving average in red for me to get excited. Tech Resources is kind of like, it's more like Cleveland Cliff, frankly, than anything else. It's a miner, gold, mostly coal, some iron ore, and then a sprinkling of others. A Canadian company, you can see how high it's been. It pulled back to 20. It's up 30% from there. At a kahuna pocket pivot, everything is green. Looks like all systems go there. Be aware of this potential for resistance at the 200-day moving average. So you think about group rotation. We haven't been talking about gold, steel, and miners in quite some time. Auto manufacturers, to me it's one name, it's Tesla. I don't know how to buy this stock. I'm too late. I thought it was expensive when it had a pocket pivot and some Bible gap ups in the 60s. And boy, was I wrong on that. It had a Bible gap up again last week on earnings. Surprised everybody by making money. Very extended stock, although you look at the high jump, it's been more extended in the past. You can see what happens. You get a red candle high at a high jump, you almost always are going to pull back. The only other ones here, the index is next. Ford Motor Company has been, they make nice cars now, been in a nice move, nice uptrend, not that exciting as to something happening tomorrow. And you can see that the daily bongo and the 15-day force are red. Next group down, we got to go 11 because that's industry group. Again, miners, gold, silver, now Alcoa. This is not the market we had a month ago. So again, sector rotation, perhaps to more defensive plays. And you could see this is another stock that's been in a downtrend, a couple of kahunas, big up move on Friday, DI crossover, green candle low on Thursday. Hard for me to get that excited on Alcoa. If I look at earnings, for example, sorry, wrong button. Not much in the way of earnings growth here in a downtrend, but these are the things that start moving when you go defensive. So whether people are buying the laggards, selling the leaders, they're buying things you can hold on to. You would think that some people think we've got an inflationary market coming with interest rates potentially going up and people wanting to hold on to the metals, I think it's more of a defensive play, personally. The next one on the list was the aluminum index, the Century Aluminum. None of these I would have paid any attention to in a rah-rah market. Next one down, Diversified Banks. And these are a lot of the international banks. So it's interesting, the big U.S. banks getting hammered and the international banks, Brazilian, Irish, English, German, leaders. Sure, everybody's in this bank. This is an Irish bank, and I'm joking when I say I'm sure everybody's in it. But this might be further evidence that there is, you could see just a huge takeoff last week, multiple kahunas. Perhaps that's further evidence of emerging market strength, seeing these banks coming back. I have no idea how coal got into the list, except it means that the things that did rah-rah, cha-cha-cha stocks have rotated out. And what I see on coal, these are bottom fishers that are starting to move. We saw Walter Energy and Cleveland Cliff and Techminco, all of which have a gold piece. Here we have BTU, pocket pivot, a couple kahunas, a DI crossover, broke above the 50-day moving average, will probably run up to the 200 to test resistance. ANR, broken record. How many times have I heard Ian tell me if I see 3 kahunas up in 5 days that I should pay attention? So here's 3 kahunas up in 5 days, breaking above the 50. DI crossover, starting to turn green except for accumulation. Very early on very ugly stock charts. And it just blows my mind that these are the ones Consolidated Energy pulled up to that 200. We'll see if we can break above it. It blows my mind that this is where the leadership is, and that worries me. Internet software and services, no question. Cloud had a great week last week. Groupon also had a great week, beating earnings. And you could see it had a Bible gap up on Thursday, probably still purchasable right there if one believes in their story. When it's below the 200-day moving average for a long time, it tells you this was a stock that was in a long-term downtrend. But you know what? It's had a nice, gentle saucer here, breaking out here, probably a viable gap up. Rack space, below its 200-day moving average, but had a kahuna and a pocket pivot on Friday. Baidu, loved the company idea. The stock was in a long-term downtrend, broke above its descending 200-day moving average in July, and then pulled right back, broke above it, and then on earnings has had a couple of viable gap ups. It is now up to 135. Hard for me to buy this stock here. I'd like to buy it on a pullback. Fertilizers, everybody was hating these, and now they seem to be liking them again. But you notice what's not here is potash, CF, and Mosaic. So these might be different than the traditional potash companies. Now, except you have Intrepid Potash on top. Let's take a look at the first 3. Again, are we seeing a theme here? I'm not looking at the worst. I'm looking at the best over the last week, which really tells you how bad some of this market must be. It's below all the moving averages. I can't buy that stock. Don't know anything about Young International. I think it's a Chinese fertilizer play. The China stocks are in vogue. It doesn't make any money. I could always go here and see if it really doesn't make any money. ONG. Marcus Smith doesn't even recognize it. That's always a bad sign. Hard for me to get excited there. SQM is a South American fertilizer play. I've made money in this stock in the past, but I'm not sure I want to risk trading it right now. Where are we going long? Silver, gold, steel, miners, healthcare services index. This is a very mixed up index with a lot of different things. We'll go through a couple of them. Air Method, I believe, is a leasing company for the air ambulances. And you could see, actually not a bad-looking pattern. Pulled back, broke above the 200, 2 kahunas, 3, 4 kahunas, giant volume on Friday. Had a DI crossover, everything turned green. Probably worth taking a look at. I can't believe I'm saying this, but one of the better chart patterns I've looked at today here. Then we have a series Amadeus breaking out, Gentiva breaking out, and then let me see what else I want to show you in this group. BioScript and Addis. These are all specialty pharmacy plays. Addis, perhaps the most constructive looking chart. Something must be going on with reimbursement for specialty pharmacies, and maybe Dr. Ghilardi, who is an expert in this, might comment on the board if it's not a conflict of interest, because he probably works with most of these companies. ACHC, which has been showing its place a lot, is in the infusion business and nursing home business. Fresenius is a renal company. So a lot of different things here, but healthcare services, as a rule, looking pretty strong. So I don't know about you, but when I go through a big list of stocks, and that's the best that I can find, it tells me that this is not a very strong market. So I've identified some things. Let me show you some things that I saw on my own. First thing is last night I did a GIF, and I found the top 10 right now. So let's take a look at those, sort of more of a bottoms-up approach. See if I want to make any comments on these, it'd be a little bit different. So this is more looking at the best in the market, not looking at just those that are in strong groups. Noaa Holdings is a Chinese VC company, a bank. It was a Bible gap up, kahuna, huge volume. I'm not sure I'm in love with the earnings per share here. It reminds me a lot of when I bought my VIPS, but you could see it had a cup, broke out of the cup here, has earnings per share. Is this worth $20 a share? Probably. Is it worth 30? The way things are going, who knows? So it makes the list. Noaa Holdings. Encore Capital Group made the list as well. Big kahuna on Friday, volume breaking out. I'm not in love with the earnings on this stock. Santeris has been one of my favorites, and I know somebody made a comment that after watching last week's very bullish video on Santeris, he covered his short, which was a good thing because they had a Bible gap up on earnings. This is one of the rare pharmacy plays that has good earnings growth, and I think the stock will continue to run up. Owen Financial, I own some of this as one of the mortgage processors. It's had a big run, and what I really like about OCN, and there's NSM or NSR, I can't remember which one, and WAC, Walters Asset Corp, are also similar, is this stock has got just great earnings per share growth. It trades at a multiple of 30. If it really makes $4 a share this year, is it really a $50 stock? Because that takes its multiple down to 12. I think this is a stock that can double from here, and it's already doubled this year, and it's one that I like a lot. As I said, it's one that I own. Conn's is an electronic and appliance retailer. Someone's got to furnish the new houses. It's in a big run. You want to buy these guys in pullbacks. It's extended, but high jump is off the top. Valley, I own MPEL in Las Vegas Sands. Gambling has been very strong. We looked at multimedia games, I think, last week. Just another strong play. These are the stocks that I normally like to buy, stocks that are breaking out. I'd rather see this thing come down a little bit in a pullback, or at least go sideways a little bit. Certainly a leader. FleetCor, a little bit of Visa, a little bit of refiner, a little bit of retailer for the trucking industry. Last night I talked about it. Looks like it's putting in a flag, and maybe it wants to run again. Certainly been a leader. It's had a long run, but really hasn't had a whole lot of deep pullbacks. Got that in one of my portfolios. And then Yandex, which is the Russian internet service and search firm. giving you a little bit of a pullback. I guess I could, if I actually believed in all these things or knew what I was talking about in them, I could start looking at, is there a bit of a triangle formation and it's going to break above or below and I want to go the direction of the break. So there are strengths. Here's that Acadia. I thought it was an infusion, maybe nursing home. Let's see what it says. It is a specialty outpatient facilities, inpatient behavioral health care, psychiatric and dependency, so drug addicts and psych patients, outpatient and inpatient. Certainly a lower left, upper right-hand leader made a lot of my screens this week. So those are a way to find leaders. If the market does well, these leaders usually do well as well. Let me just look at my buy list and see if there's anything that I'd like to point out tonight. I have a big list. I have a big list of ugly stocks. So I'm going to go through my sub lists. There were a number of viable gap ups that I found intriguing. And so let me just run through them real quick. I'm now at my hour, so I'm in overtime. This is a stock that I owned. Could have bought it back here, could have bought it back here. And it had a breakout on earnings, which I thought were a miss with the viable gap up on Friday. I'm going to put very tight stops on this guy. It doesn't make money. I don't understand it, why it went up so much. And I got a nice profit in it, and I'm going to be very tight on my stops. Harman International. I put myself through med school by selling stereo equipment. This one broke out last week, had a viable gap up on Thursday. They bought all these companies, and the audio business is dead. I was shocked that they're doing so well. And then I realized why. My wife got a new Land Rover, got a Meridian system in it. So they own a lot of the companies that put the high-end stereos in cars. Ubiquity Networks is one that had pulled back for a long time. They had a kahuna on Thursday and Friday, pocket pivot Thursday, and the Bible gap up Friday. Good earnings growth coming into the stock. Noaa we already looked at. Here's one I liked a lot, but it is speculative up the wazoo. Bible gap up on Thursday, big day on Friday with kahunas both day, huge volume, everything is green. It is at the high jump bar, so you got to be nervous. Look at the earnings per share into this stock. Beta, Chinese automobile company on the internet. This is what I look at. I see a stock that's worth $20 or more, $21 if it keeps its multiple, maybe more expansion of the multiple, higher growth rate. You know, it's a Chinese stock, so you never know how much to trust the numbers, but it trades over 1.5 million shares a day, and it's had a big run-up, and you're probably better off buying it as a pullback. My gut is that this thing just wants to run further. Will Brothers is in the oil equipment business, so it was a pullback. Got above the 200 here, had a kahuna, lots of volume, viable gap up, makes money, and if I remember correctly, a lot of earnings coming into the stock. So this made my list. So it's turnaround stock to make earnings. If it makes 72 cents next year after losing money the last 4 or 5 years, it's probably worth more than $8 stock. And it had a viable gap up. So Fun was one of my favorites last week. Went sideways for a couple of days. It had a viable gap up, still looks attractive, not on its earnings. And I've lost a ton of money on this guy in the past, but look at the earnings per share growth coming into Power Secure International, POWR. So trades at a multiple about 50, 88 cents next year. By my calculation, that's 40. Cut the multiple in half. It's 20. It's trading at 17. That's a 20% return, even with discounts. So I think that one looks good. It's viable gap up. O'Neill, Morales, and catcher rules need to be applied. That's the Bible gap ups that I liked. Bottom fishing for nuggets. I hate to even show these two, except my bottom fish choice last week worked well. CPSS, I kind of look at them like the OCN of the auto loans. Probably not the same story. This one was a high flyer, pulled back, had a kahuna on Friday. If this thing gets above the 200-day moving average, I'm probably going to buy. I'm not going to give it much porosity below the 50-day moving average. If it doesn't get above the 200, I'm not going to buy it. And why would I buy a stock that looks like it has no earnings? Because I think somebody's wrong. Because if it has $1 in 2014, it's a double from here. I had owned it in the past. That's a pretty big pullback. I think it'll give you some opportunity. And then I don't know anything about this, but it's a pretty beaten up income producing fund, or ETF, I guess, closed-end fund, pays a 6.2% dividend. I don't know. I should take that off my list. I don't know anything about this, but I like the dividend, and it met my bottom fishing criteria. Then I look at breakout EPS All-Stars. These are ones that have just great earnings per share growth coming in. Now, these guys both look like they're turnarounds, which is interesting. And those, to me, are sometimes the best performer. Enter Plus, we go into not great earnings, but it's a turnaround play, natural gas play, giving you a cup and a handle, a run up to 20. Not out of the question, a couple of kahunas and a pocket pivot. That's what got my attention. And then Take-Two Interactive, big earnings per share growth. The stock's already had a big run, but one that I thought still looked compelling. Leaders extended or gone. Most of these we've already looked at. Valiant, I think, is still interesting, although it's getting expensive. I don't know what to do with VIPS. I mentioned this when we looked at that auto online company from China. I got into this stock, and it just hasn't looked back since I bought it down in this range. So I've had a 50% return in about a month. Great earnings per share growth. I'll raise my stops. If China gets better, it might hold up even if the U.S. is weak. I doubt that, though. Pullbacks ready to run. These are those things that are sitting down there that have had a signal. So we'll look at Rio Tinto. We already looked at it. But when I put a stock and call it a pullback ready to run, it means they've been beat up, and something has showed me a change here. So breaking above the 200, a pocket pivot, a couple of kahunas, huge volume, and a viable gap up. That's hit me in the head and saying, Jeff, wake up. People are now accumulating RIO. And one I don't know anything about, but I'm very compelled to buy if the market allows me, is this one here. I mentioned emerging markets might be improving. Vale is an emerging market in Brazil. Well, so is this. And what a squeeze we have here, breaking out above the squeeze with a pocket pivot, a couple of kahunas, a DI crossover, mostly green up here. Great earnings per share growth, BRFS. The Brazil market's been clobbered. It was in an uptrend, pulled back to major moving average, broke above it. Great earnings per share growth. Trades at about 22 bucks. If it makes $1, and it's going to be a $30 stock. And I think that this one is very attractive and viable. One of my favorite patterns is those pullbacks in a uptrend. Albany Molecular Research is giving us one of those right here. Pull back to that 50, which, as you can see, has been support every time it's gotten here. I've got that kahuna setting up for me a buy right there, if not a buy already. Pullbacks waiting for signal are stocks that have pulled back that I won't touch unless they give me a reason. So I'll look at Xerium as an example. And you can see the stock has pulled back. This is what I like. Now give me something. Give me a big volume day. Give me a kahuna. Give me a pocket pivot. Give me a viable gap up. You gave me a red candle high. I need a little bit more evidence, but I think this is, this is the kind of stock I like to buy. It's pulled back to support. It was clearly in an uptrend, preaching, what I, that I do what I say I like to do. I look at the earnings per share growth. It's a turnaround play. If it makes $1.33 in 2014, is it a $10 stock? I think not. If I'm right, we'll see a kahuna or a pocket pivot soon, and I'll be getting in, and I'll be monitoring it during the day, looking for that evidence. And then lastly, I have my dynamic special situation. So I'd like to summarize where I think we are, and then look forward to seeing people on Monday. Before I do that, I want to review one slide with you. One of the dangerous things about giving you a list of stocks that I like is that somebody out there may be silly enough to think that I'm just going to blindly buy them tomorrow. No. I've created a buy list, which includes a number of stocks that are setups, but I don't buy them until I get a trigger. So tomorrow I'll be in the market live. I'll be seeing if the market bounces and takes away my bearish thesis for a pullback, or if I'm throwing out everything and emptying my portfolio because the market just feels continued softness. If the market seems to be heading up, I'm going to then go into this screen on my trade station, and I am going to start looking for patterns. I'm going to look at intraday for which of these stocks are giving me gap ups, and then which of these stocks are meeting the criteria for a viable gap up. So I see during the day the percentage gaps, the volume percent, and I trigger a viable gap up signal when I make it on volume and gap percent. The SMA tells me that some of these may not be good ones because they're below the 200-day moving average. So I'll be looking for those during the day. I'll be looking for pocket pivots during the day, evidence that something's moving. I'll be looking at the 2X and the 3X bears during the day, looking for patterns. If I start to see a lot of pocket pivots and a lot of green in the 3X bulls, that gets me kind of excited on the bullish category. So I won't buy anything on my list unless the market looks like it's going to cooperate. So in summary, as I started with, I think that we have a market that is in transition. I see a lot of things that to me look bearish. I see divergence on MACD, McClellan, weakening, 200-day moving average, moving stocks above the moving average falling. I see 2 and almost a third Hindenburg Omen. I see rotation to defensive stocks. I see seasonals that are against us and a wall of fear. And at that note, any bullishness on the stocks that I have, and I showed you some stocks that I like, has to be tempered by where the market goes. And I'll be up tomorrow morning like most of you looking to see what I can find. On that note, I say good night, and I look forward to having some of you join me on Tuesday. Those that watch this on YouTube, I will be posting the link to sign up on YouTube. Thanks, everybody. Have a great night.